Damien.
Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have John Cole-Scott, President and CIO of CEF Advisors, Damien Dwin, Founder and CEO of Lafayette Square, and Mitchel Penn, BDC Analyst at Opco. We're here to discuss a segment of the market that may provide alternative opportunities to access attractive income streams known as business development companies, or BDCs. It is great to have everyone with us. Damien, I'm going to kick it off with you. There seems to be a lot of acronyms in this space. Explain to us what a BDC is on a high level, and what are some of the trends in this space that you're watching?
A BDC is it's a mutual fund. It's just like when we were kids and you could put your money away in an SEC regulated vehicle where there was transparency. There's a huge nuance to the product insofar as here you are replacing what banks used to do. Since 1980, the vision of the SEC and the government has been, let's attract retail and institutional investor capital to create jobs in small business. That was the genesis of BDCs in 1980. Today, you have a product that by law has to pay income on a quarterly basis to maintain its tax status. It can come in public or private flavors, which is interesting. There are three different types of BDC. And importantly, it has a long track record. What I love about the product is that it's audited by accountants. You have to disclose all your positions, all your funding on a quarterly basis. So there's a lot of data. There's a robust community of analysts from places like Oppenheimer to track and measure the performance of all the managers in the space. And I like that because I think investors want the ability to call balls and strikes and have context on particularly these private credit products.
Yeah, and that's a great point that you bring up in terms of transparency. I'm going to get your perspective on private versus public in a moment here. We'll come back to that. But when you look at the balance sheets, assets versus liabilities, what are you seeing on each side of the balance sheet? What should investors be aware of?
Yeah, so you'll love this part, and it's very interesting. There's a leverage limitation for BDCs. So interestingly, you can be a bad investor, but you're not going to blow up over levering yourself because the regulators have their arms around that. This is less leverage than you'll see in a commercial bank. It's less leverage than you'll see in a hedge fund. So it's pretty interesting that there's a leverage governor to go along with that transparency point we discussed just a minute ago. With respect to the asset side of the balance sheet, we're seeing great performance. Non-accruals are actually quite muted right now. That's a fancy way of saying you're not seeing a lot of bankruptcies and a lot of companies failing to pay their interest. The landscape that is being served by BDCs is vast. There are 240,000 companies in America with less than $1 billion of revenue. In aggregate, BDCs have only invested in 6,000 companies. Think about that. So there's underpenetration, and the demand for credit is voracious. We have a steepening yield curve. We have a Fed that is worried about inflation. We have an administration in the Trump administration that's implementing DOGE and thinking critically about the debt and the deficit. And so the credit extension for small privately held businesses is under intense pressure right now. And BDCs, frankly, have the pick of the litter, and the credit performance has been quite good.
Yeah. And John, great to see you as always. Welcome back to the show. Let's look at another area when it comes to fundamentally analyzing a BDC. When you think about return on equity versus net investment income, how should investors be approaching this if they're considering what that could look like in their portfolio?
Yeah, so at a basic level, BDCs, they have leverage on average about 50% over net assets. They typically have the leverage overweight fixed leverage. The loans are about 80% variable rate loans. And that's been very positive math for the last couple of years. And when you think about what you're looking at CEF data covering all listed and non-listed BDCs, you're really looking for credit performance. The NAV is important, but also accounting is complicated. You can hide things in NAV. And so return on equity is something that Mitch Penn really taught me about the last couple of years, is a really crucial way of saying, are they performing well all in. Just like we love the adjusted core NII coverage. It's a better dividend coverage level for understanding the cushion in the market at the time. But it's a great way to see, are they earning money with the equity that you've bought access to by buying shares of the fund, either publicly or in the non-traded market?
Yeah.
And is the dividend covered? Is the dividend covered, which is another big controversial point. We've seen some bad actors occasionally borrow money to pay the dividend instead of actually earning the dividend. And again, the analyst community has helped police that.
Yeah, well, Damien, that goes back to your point about transparency, which I think is an attractive feature of the product. Mitchell, you can't escape this question. Everyone is, scratching their heads in terms of how asset classes will be impacted by tariffs. Do you think BDCs will be impacted, whether for better or worse?
We've asked the BDCs that have reported this quarter, and most of them say it won't be much, but they don't know. It could be indirect, right? If the tariffs cause inflation and the Fed doesn't want to lower rates because they're worried about inflation, you could keep rates higher. So I think we're going to need more time. I think the BDCs are going to need more time to see how it impacts them directly.
Yeah, that's a good point that you make, because at the end of the day, it's all about execution at this point. You're just speaking policy right now, and it's anyone's guess. But when you think about, John, let's get back to the fundamentals for a moment here, the dividend outlook for BDCs. Part of the attraction to it is the opportunity to derive income. So how should investors be approaching dividends as it relates to BDCs?
Well, good. So we look back to a relatively high level of pricing for BDCs back in August of 21, about an 8.5 yield for our index, about 101% dividend coverage. Year end, we were coming in around a 10 and change average yield for the index, 120% dividend coverage. In the last about 60 days or so, dividend coverage with those that have reported is at about 115%. Tremendous dividend increases through the recent rate environment. The average yield on debt in the portfolio is about 12 and mid-change, and we're paying shareholders about 10.5. And so what I'd say is that we don't expect many extra dividends except for as required by the rules. We believe most BDCs that we cover and focus on will keep a lot of their surplus as cushion for the change of interest rates. And for percent non-accruals, they're still under 2%. They're about 1% back in August of 2021. They're about 1.7% now. So still elevated, but not aggressive. And we think there's a lot of cushion in the space. And as Mitch and anyone else will tell you, it's not just buying the whole basket. It's picking the manager, picking your spot, and being reactive and proactive. There's over 50 listed BDCs. You can buy 5 to 10, actively manage the allocation, and do great work for yourself.
So John, that's an important point in terms of understanding the what's happening right now. So we looked at the last 8 names that reported this quarter, and what we found is the net interest margin is shrinking. And it's shrinking right now because, remember, base rates, the Fed cut rates recently. And the other thing that's going on is loan spreads have tightened. So we had loan spreads a couple of years ago widen when Silicon Valley Bank had those issues. Mm-hmm. And now, as the economy's doing better, you're seeing loan spreads tighten. And what happens in a floating rate loan is you're able to refinance that loan at a tighter spread, a lower rate. And so we actually, on the 8 names that have reported, we've seen about 100 basis point decline quarter over quarter of the NII margin, which means ROEs are going to come under pressure. We don't think the core dividend is going to get lowered. What's happened is, if you look back over the last couple of years, BDCs have paid a core dividend around 11%, and they've added specials and supplemental dividends that kick that up to 13%. What we think is happening is those special dividends and those supplemental dividends are likely to go away over the next 2 years, and you'll be left with that core dividend.
Is that a positive for the product then, Mitch?
So you have to think about it. When rates are falling, right, you have an income product. Well, it's off of the base rate, which is SOFR. Well, if SOFR's falling, rates will come down, but so will the equity discount rate, right? So, because the risk-free rate's coming down, you're gonna bring that equity discount rate down as well. So I think they'll still trade well, but you will get less income. So you'll get the 11%. You won't get the 13% with all the specials.
Right. So, Damien, let's pull the lens back here for a moment in a more overall perspective on private, non-traded versus public in this macro environment that we've been discussing.
Volatility, correlation, diversification of income streams. These are the bedrock issues that you have to solve for. My harshest critique of BDCs is the exposure to private equity. When you lift the hood, the big guys invest in private equity controlled businesses 90% of the time. And the further harsh critique of this space is correlation. You'll see as much as 50% of cross holdings among the large players, which brings you back to that penetration point. If you've only invested in 6,000 companies out of a 240,000 company opportunity set, and your largest players buy the same deals 50% of the time, have you diversified yourself? To the extent you have not diversified yourself, then it comes down to the liabilities. Where are you on? The source of leverage, the duration of the leverage, the cost of the leverage. And you'll find you can pick winners and losers in terms of who has low cost, long duration liabilities. Which brings us back to Washington, D.C. The SBA is the source of the lowest cost financing for private credit through the Small Business Administration's SBIC program. You can get 10-year leverage, fixed rate at a 67% advance rate. The private markets don't provide that. So Washington has a dog in this fight. And for the big managers who are out here, we really have to be careful about seeing who's bringing value to the space, investing in a new set of borrowers who, in my view, moving forward will be not private equity owned. They'll be non-sponsored, family founder, entrepreneur owned businesses to help spread the access to credit to a larger audience.
Yeah. Well, John, what if BDCs get back into the indexes in 2025 and 2026? Will that help to elevate the story a bit? Make it more investable?
I mean, we launched our BDC fund back in 14, right after they'd been removed from the indices. And there was roughly a 15-20% pullback just from the lack of liquidity, who can buy them, for the listed BDC structure. We think it's been tough, yes and no's for the last 10 years of my career, going to conferences, chit-chatting with the lawyers, the lobbyists, the BDCs themselves. We think this administration and their approach to regulation is probably the most likely we've seen in a long time to lift that. And at a basic level, it puts them in the ability to be owned like any other stock. Now, the interesting about BDCs is they are both a closed-ended management fund under the 40 Act, but they have an earnings season. They file Qs and Ks. So they are truly a hybrid structure, but they really should be allowed to be purchased by anyone that buys anything the Russell 2000, in our opinion. And that should propel prices higher just simply by the magnitude of shares and the ability to buy it from different investment management policy statements.
So let's talk about that for a moment here. When you think about discounts, right, that's another fundamental that you want to pay attention to. How come it doesn't matter nearly as much for BDCs versus closed-end funds?
You want to tackle that, Mitch? You're really good at this topic.
Sure. So the reason that discounts don't matter as much is we look at return on equity, and there are BDCs that generate very high return on equity, sort of 12, 13%. And they should trade at a premium to book because they're generating such high returns. The folks that generate low return on equity, they're going to trade at a discount to book. So it all, we're really looking at what the earnings are. And think about it, stocks trade on earnings and expected earnings. And so if you have BDCs that do well, they'll trade at a premium. And if you have BDCs that don't earn high ROEs, they'll trade lower. Well, one thing I will tell you, we broke the BDC, we cover 33 names, and we broke them down into 4 quartiles. And what you find is that the top quartile generates an average ROE of 12%, and the bottom quartile trades with an ROE of 4%. That's a big difference. And guess what? The bottom quartile has the highest dividend yield. The bottom quartile's dividend yield is 14% on average, and the top quartile that generates that 12% ROE their dividend yield is 9.4%. And it just goes to show you that the market's okay because they know they're getting value with that first quartile. They're earning quite a bit of money.
And then we also look at the expense ratios and how fair they are. Look at it over gross assets, which is a far more appropriate metric, and whether there's high watermarks, hurdles, and also how good is the fund to their shareholders? Do they treat them well, which tends to trade well above book? Are they internally managed? That's often another 15, 20% push to their price to book. And so it is far more complex than simply sift on discounts or yield. And we typically tell investors and advisors that deep discounts, usually the NAV trends to market price more often than the market price trends back to NAV, unlike traditional closed-end funds.
So, John, I have one more question for you. I'm hearing a lot of the same terminology that you would with a REIT as an example. Can you explain what the nuances, what the differences between a REIT and a BDC? Because when I think of REIT, I think of ROI, income generation. It's not analyzed quite like other funds or equities are. Are there differences with that?
They have the same 90% payout of income to maintain their tax-free pass-through status. Same for REITs, closed-end fund, any 40 Act fund, as well as MLPs. But the main difference is they're under the 40 Act. So they got a little bit more scrutiny, a little bit more transparency. They have that more independent board generally in the U.S. And so I would say they sit equally as a fund, like any ETF open-end fund, but again, a little more volatile traditionally. And they sit with that additional same pass-through tax status. And a lot of income investors like, and traditionally they tend to yield on the higher end of the spectrum. But Mitch is right. We typically tell people if you're not sure what you're doing, lop off the top half of the yields and you're usually in safer waters.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.